Boom. Okay, that worked. Sweet.
Should I get started, Connor?
Yeah. You can share your screen. Yeah, you're good to go.
Okay, so just a bit about me and maybe the talk of today, and then I'll just kind of go over what I'll do. So I was hired in 2013 to get started with the real estate program at Cal Poly. So real estate program at Cal Poly was under the econ major before, and then we slowly moved it under the biz major. And slowly the enrollment has gone up. I think it was 3 before under econ, and now we are at like 44 people. So I don't attribute that to me. I attribute that to the fact that real estate is hot and a lot of people want to do real estate, which is the whole reason why you guys are here. And so just to let you know, real estate is very cyclical. So back when I was doing my PhD, I started in 2008, and 2009 was when we were going through a Great Recession. So in 2008, I was a TA and grader for my advisor, and she had 183 people in her class the first year. And then when 2009, when the market crashed, she had 20 people in her class. Okay, so it's extremely cyclical, real estate. So just keep that in mind. Your interest in real estate is because if you go around, real estate markets are hot. So what am I going to ask you to talk about today? And it's a real estate investment club. Real estate investment, and the topic is real estate investment. So I'm very cognizant of that. So let me step back a bit, and let me just ask you, when people say real estate investing, what do you think about? Let's just go over different sort of ways in which you can invest in real estate. And Sasha and Tyler, you don't have to say anything.
You're not allowed to say anything.
Go for it, Sasha. You could get
I was just going to say one form is just like tangible investment and purchasing like a investment property yourself.
That's right. So when people think of real estate, like typical real estate, they think of physical real estate, right? So I often get all sorts of people coming in my office before COVID, and they would ask me questions on that they want to buy a apartment building or whatnot, and what should they do. So in general, their interest is how to build a physical real estate. And I do mean physical. What else can you do? What else is real estate?
You could invest in a REIT.
You could invest in a REIT.
So you don't have like physical ownership of the property, like you're not the landlord yourself, but you're investing in a group that invests in physical property. So you are experiencing returns based on investment in real estate.
Right. And I think Sasha is basically killing my thunder here. But and so what I will basically say is, you know how you can invest in, let's say, stocks, and they tell you put $50 and buy the S&P 500 or something, whatever you can do through Robinhood, you can do the same stuff with real estate. And so the whole talk today, I'll just speak about some of the new ways in which people are investing in real estate. So I'll give you 3 examples. Most probably I'll just give you 2 examples. One is I'll give you an example of a REIT, but it's a e-REIT, so it's online. I'll explain what an e-REIT is. And I'll also explain sort of how people can invest in real estate. So when I said when you buy physical property in finance, what you really mean is you're taking debt perhaps, and you're buying equity. You're sort of owning equity in real estate. So which means that if the value of the property goes up, all of the residual value that you pay off after you paid off debt, all of that accrues to you. Okay, so that's what it means when you own equity. But what I will argue is that is a very narrow and perhaps more risky way of looking at it. Perhaps you may also want to consider owning debt of real estate. So let's say I'm going to bring an example up. Let's say if Kiana wants to own a property and she took out some debt, you may want to actually, and that debt, you may actually want to subsidize that by giving her some of your money in the form of debt. So you don't have to buy equity. You don't have to go to Kiana and say, hey, I want to be a shareholder in your company and we both can go and buy real estate. You can invest in her sort of property in a different way where you can just say, I want to sort of give you debt so you can do your stuff, but I just want to get stable income going forward. Okay, so you could do that as well. So in the first example, I'll show you sort of simple ways in which you could do so. In the second example, I'll show you how cryptocurrencies are completely disrupting this market. And I'll go over a couple of examples for that. Okay, so those are the two ways. What's up, Jack? The person who probably knows more about this than me, who knows more about this talk than me is Jack. So Jack, so keep that in mind. Any questions before I go on? My goal is to talk for maybe about 20, 30 minutes, and then I'll leave it open for questions. So let me share my screen. And I always like it. So if you have any questions, please interrupt me. You will get more out of it if it's more interactive. Okay, so the first thing I want to do before we even go on is just answer the big picture. Why real estate investing? So let me just pose that question to you. Why should anyone invest in real estate?
It's scarce. Scarce.
Like
there's only going to be so much real estate, I guess.
So Connor, let me push back. Why don't I just buy Starbucks? The Starbucks, apparently, if you look, or McDonald's, if you look at their sort of balance sheet, most of their assets are in real estate. Why don't I just buy Starbucks or McDonald's? Why do I need to buy real estate myself?
Well, I guess people need a place to live, and the Starbucks and McDonald's aren't really going to provide that. I mean, I guess they could sell their land. And then also inflation. I guess there's a bunch of other things, but it typically keeps up with inflation, if I'm not wrong.
So to keep up with inflation, you can buy gold. Why real estate?
I mean, I guess you physically own it, and you can develop it. You can do whatever with it. It's yours. There's other reasons. I don't have all the answers.
Anyone else? And I'm not being flippant. It's actually a philosophical question, because I can, rather than owning real estate myself, going back to my old example, I can just collaborate with Kiana and put some money in her project. Sorry, Kiana, I'm using you. And that's it. That's my investment in real estate. Like, just imagine from a finance perspective, if I bought a property in, let's say, San Luis Obispo, and let's say where the Black Horse Coffee was on Choro, right across from Slodoco, where they're making all this huge construction. Let's say you bought a property right there. You're one earthquake away from getting that property completely ruined. It's risky investment. You are one sort of bad tenant away from getting that property completely ruined. That tenant can literally put concrete on your fireplace or your chimney, and then that could cause huge damage. You are one plumbing mistake away from your property being completely flooded.
Wait,
why would you ever?
Is concrete in the fireplace like a real example, or like did somebody actually do that?
Yeah, in great recessions, people would do that. So right before they would get evicted, they would put concrete in the chimney because they would be saying F you to the bankers or whoever was kind of evicting them. So why would you want to invest in real estate?
Maybe because you like the cash flows. You can kind of model out tenancy and see your returns beforehand, depending on the asset, of course, but it's kind of like buying a dividend-heavy stock more than buying like a stock like that.
Yeah, so it's very much, I think I was trying to be flippant a little bit. So whatever Connor said, whatever Jack said, it's true. And in general, what it means is, when I say real estate investing, I will never ask you, that put 100% of all your money in real estate. I have a bunch of family members and I ask them, are you saving for retirement? And they would say yes. And then I would further ask, what are you putting your money in? And they would say everything is in real estate. I think that's a dumb thing to do. I will never, ever, ever ask or suggest that you should put 100% of the money in one sector of the economy. That will never happen. So I think the right answer here would be that real estate does seem to provide good diversification and a good risk-adjusted return. And that's why you should invest in real estate. It's just simple. So do not ever think, whatever I'm saying, don't think that, oh, I'm asking you to put 100% in sort of real estate. I will never do so because I don't think that's optimal. Okay, so let's, okay, so is that clear? Any questions on that one? All right. Now let's talk about physical property, because most of the talk I want to go away from physical property. Why would somebody want to buy physical property? Like Kiana's property.
Properties may tend to appreciate, so you can experience appreciation with your property and then sell it for profit.
Yeah,
Also, passive
Apple
income.
stock, Dogecoin seems to appreciate. Why not put stuff in there?
Passive income is also very attractive for investors, having an income stream through tenants.
So again, Sasha, REITs will give you that. You guys don't know what REITs are. I will tell you what REITs are, but REITs will also give you this. So why physical real estate?
Is it the tax advantage?
That's right. That's right. So the other thing that you want to think about from real estate perspective, and when you think real estate and think physical real estate, just literally think Donald Trump. And just think that if you own physical real estate, this means that you have to consider taxes in your sort of analysis of how you're sort of investing. Real estate people do not pay taxes. Donald Trump is not the only one not paying taxes. Any real estate person who has physical real estate, they don't pay taxes. If you come across some real estate person that pays a lot of taxes and they own physical real estate, do not invest with that person. They are not optimizing. If you're good at optimizing, you do not pay taxes. And the reason is because physical real estate is depreciable. Okay, so you can create, there's a depreciable basis. So you can depreciate your property, which reduces your taxable income. You're not going to get deeper into this, but that depreciation option that you have, the fact that you can depreciate your property, is extremely valuable. Also, the way you can structure deals so that, for example, when I own Dogecoin, and if I bought it today and if I sell it tomorrow for a profit, I have to pay taxes on it. I have to pay short-term gains on whatever money I made to the IRS. It turns out that with physical real estate, again, physical real estate, if Kiana had her property and if she sold it to Jack 5 years down the road, she can structure a deal where she can defer her taxes, capital gain taxes, potentially forever. Okay, so any analysis that you do with physical real estate, you have to keep taxes in mind. Okay. Any questions here?
Do you think Biden's new tax proposal and like the chance that they may eliminate 1031 exchanges could hurt the business?
Yeah, a lot of people are saying that's, yeah. So basically what Jack is asking for is, going back to our old example, is Kiana, if she was to sell her property to Jack, for example, she would enter into what is called a 1031 exchange, which just means that she would be able to exchange her property for another like-kind property. So she could sell the property to Jack and in turn buy another property from Sasha. If she does that, which is an exchange, and she can structure it if she follows other rules that she does not have to pay taxes on, the capital gains taxes. Okay, so she can potentially do that forever. And so a lot of people believe that people who own real estate, because they have never paid taxes, they should be paying taxes at some point. Okay, so Biden administration, the people who work for him, they tend to believe that we need to change the laws a bit so that people are not allowed to do such things going forward. And so we need to sort of change the law so that they pay taxes somewhere. And so Jack was saying, like, is that the reason? So if you penalize 1031 exchanges, is that going to lower the amount of transactions that happen? Because people are doing some transactions so that they can avoid taxes. And I do believe that, yeah, probably that's correct. All right.
Professor, can you elaborate on the depreciation aspect that you're describing? How if you depreciate your property, you're not going to be paying as much tax.
So let's say let's start with all of you, okay? So let's say you get paid $72,000 a year. So that's $6,000 pre-tax. Without knowing too much about how exactly your household formation is, you can pretty much predict that if you take 12,000 out from that 72,000, because that's standard deduction, your taxable income is $60,000. And from that, you will pay 9% in California state tax and probably 20% in federal state tax. So about 30% of that 6,000 is going to be gone in taxes, right? And so you're going to be paying a crap ton of taxes. On the other hand, if all your income was coming from, let's say, a rental property for student debt, what you can do is, let's say you're getting paid $60,000 again, or $60,000. What you can do is you can reduce your taxable income. So you can say every year my student dorm is depreciating. And so I can, let's say, reduce the value of that property by 1/27. You can depreciate over 27 years. And that part reduces your taxable income. And so 30% that you pay will be over a smaller amount. So you will pay less taxes. I don't know if that helped you or not.
Yeah, thank you.
All right, so what I'll do now is go over what I suggest people do. And we will not talk about physical, but we will also keep in mind that when you want to invest in real estate, you always may want to consider physical, but so if you consider physical, then taxes is an issue. And also with physical, you just have more headaches. Okay? Your tenant has some bulb not working or their plumbing doesn't work. You just have a lot more headaches. Okay? So for most of us who don't want headaches, this is kind of what I would suggest. Okay? So, and I'm not getting paid by these two companies. So I'm just kind of telling you that this is sort of the new way of investing. Okay? So the first thing that I'll go over is a company called Fundrise. Okay, so what is Fundrise? I had logged on this morning to prep, so let me see if I can log in. Oh my God. Okay, so let me see if I can just show you what they do. I created an account this morning. So I do have some money in here, so full disclosure, but I created a separate account for the class. So what they do here is they just say simple thing. Everyone, like we talked about, should have some money in real estate. Okay, so let's say you decide to save $200 a month, okay, or $200 a month. So maybe $150 you put toward the stock market, and you have $50 left, put it toward real estate. And the question is, with real $50, you cannot buy physical real estate. And honestly, if you guys go and say, hey, I want to buy physical real estate, I want to buy that property across from Choro, people will laugh at you because probably you don't have the income or the experience to support that. So you won't even get a loan. But nonetheless, you may want to buy real estate. And so this website kind of tells you a simple way in which you can buy real estate. What they say is you can choose your portfolios. So you can say, you can choose, let's say, a basic portfolio, and the minimum investment there is $1,000. Or you could choose what is called a core portfolio, where the minimum investment is $5,000, or advanced portfolio that has some other stuff. Okay, so let's go over. So the question is, Pratish, what is this? Okay, so the key here is, this is, I would say, a diversified way of looking at investment in real estate. Okay, so if you look at core portfolio, again, this depends on what kind of your goal is. So as most of you pointed out, that when you buy real estate, the reason why you want to buy real estate is you get stable income. It's almost like buying a dividend stock. And that's it. I mean, that's why people rent, right? So you get rental income. So if you buy that kind of if you have that kind of a sort of goal, then maybe a supplemental income portfolio is good for you. So let's just go over what this is. Okay, so let's go over the details. And let me just go over the portfolio. Okay, so, and this is what I was talking about. So apparently when you do this, when you invest in this, what will happen is every $50 that you put in every month, on top of the $5,000 that was required for minimum statement, you will get some portion of the shares of this fund, small portion of the shares. The money that you put in is going to be used to invest in 24 active projects. These active projects are spread out across United States. Okay, so you don't have to worry about an earthquake or a plumbing thing because it is spread out. Say a hurricane in Florida, I mean, it causes heartburn, but it may not be like a life-ending thing because you're kind of diversified. Okay, so let's just go over sort of what they are doing. Okay, so the first project here is home construction in Upland, California. And it's the strategy is fixed income. So let's just say what that is. Okay, so if I click on it, if I go to view details. Okay, so apparently it's a new construction. So this is a rendering that they gave. And then what you see here. So, oh yeah, you see it here. So what you see here is when you put $50 in this fund is trying to buy, has put money in this new construction project in Upland, California. But the key here is they have not bought equity in this project. They have bought debt. It's the same analogy that I gave before, is when Kiana wanted to buy her property, you're not buying equity in her project, you're buying debt in her project. Okay, so which means that if this value goes up from 1.6 million to, let's say, 3 million, Kiana gets to keep all the residual cash flows. She has all the upside. But what you get because you own debt is you get 8.9% interest. Okay, so the developers who are building this, they took debt and they're willing to give you 8.9% interest on this construction loan that you have given them. Okay, and the interest that you get paid, part of it, depending on how many shares you own, will go every month as interest or dividend to your portfolio if you decide to choose this. Any questions here? Let me stop. Expected more questions. We can do a few more. So if you go single family rental, it's a single family rental. Apparently in this project, they have gone to the city of Forney, Texas, and they have bought 4 homes here. They have bought 4 homes, and they are single family homes. And this is Texas, so you got to imagine. So with 4 homes, they're able to buy 800. They're able to buy 4 homes for $861,000. You don't see that in California ever. Okay, and then what they're doing is sort of giving you a sense of sort of what will happen to the homes. So in this one, for example, this is pure equity. This project, they have bought complete equity. The other project in Upland, it was debt. And what they will do is they will own these homes and they will rent them out. And then every month, based on the rental income, and then they'll have to pay property taxes and so on and so forth. After you pay off all the expenses, whatever money is left, the rental income, you will get a bit of dividend based on whatever the rent is, whatever rent that you get. Okay, so basically the idea is that if you decide to invest in this supplemental income portfolio, you are effectively putting money in 24 active projects all over the United States. So that's diversified spatially. And you also diversified in terms of what kind of money you're putting in. You're buying both debt, that's fixed income, and you're buying both equity, that's value add. And the question is, why would somebody do this? Why would somebody do this? And so if you go, they have a bunch of marketing materials. But for example, they're saying that they created this retail and apartment building in DC, and apparently they're killing it. They funded this by debt, and then they have realized about 11.4% return on all of this. Okay, so all of this will kind of flow through to you because you own shares in this fund. So the way this would work. Okay, so let's say.
Professor, so Fundrise has a portfolio through their equity, but then they also act as a financing instrument for other investors?
Yeah, absolutely. Absolutely. Oh yeah, here it is. So they have, so you kind of classify things in whatever you want to classify. So 18.1% of it is in debt. 38.8% is in like normal, good quality sort of construction equity. That's core plus. So these are like kind of new projects that you don't really need to do much. You just kind of buy them and rent them out. About 36% is in value add. So imagine these are like crappy homes or crappy commercial places that you have, and you're adding value. So you're sort of gutting them inside or outside, and then sort of renovating them and then renting it out. Okay, so that's what that is. And then opportunistic means that these are completely speculative. So you're buying property in completely like maybe an area that's like, for example, here you may be buying property in Oceano, which is south of sort of Pismo Beach, where property prices are more depressed than other places. Okay, so you're sort of waiting it out, hoping that the value of the property will kind of go up quite a bit. Any questions here?
And then I think they have like 2 or 3 other plans too, which look pretty cool
Yeah.
as well. You can kind of just pick your plan as well.
Right. So if you go to long-term growth, for example, so this plan, and so this plan is going to be focused more on the opportunistic side and less on the dividend paying side. Okay, so they have more of their portfolio in value add and 16.4% in opportunistic because they're speccing it. They have a longer term horizon, and they don't have that much on debt like this, because this is all about the upside. So they're not investing in debt, they're investing in other equity related projects because they want the upside.
Professor,
Any
so
questions?
Fundrise,
Yeah.
Are they vertically integrated? So are they developing property and doing everything themselves?
I don't think they do build and design. They are the ones they're more from the finance perspective, like PGen.
Gotcha. And what do you think the kicker is? Like, where does Fundrise make money off investors?
Oh, so every dollar that you put, I think they take a certain chunk of their chunk of that money as an expense fee, but this is normal because they're managing the projects. They're sort of doing all their due diligence and all that stuff.
Taking
So
on the
they're taking, but this is a new way of doing it. And why is it new? Or why is it cool? Because and it's cool because I'm a millennial, and I firmly believe that. So, for example, you can literally invest in all of this without thinking about it through your phone. Yeah, you don't have to do that nonsense of going to places, checking out the real estate sort of stuff. This is a new thing, but it's well established now. They have been around for more than 5 years, and they seem to be doing okay. Okay, so slowly, I believe that the old sort of model of doing real estate construction is going to move away to sort of new projects like this.
What's the difference between investing in like Prologis that's on the stock exchange and like Fundrise, which is not?
That's an excellent question. So your first question is, Pratish, why did you choose Fundrise? But Fundrise is what is called a REIT. So what is a REIT? REIT is just a way in which if you put money in REIT, they will in turn go buy other properties. Okay, so you could buy REIT in the same way as you can, so you could as any stock, right? They're all traded on a stock exchange. So the question that Jack asked is, why can't Jack believes in, like, you can tell from his background that he believes in industrial sort of real estate. Like he wants to buy data houses, warehouses and stuff like that. And so one of the stocks that does this is Prologis. And so he's saying, why can't I just buy Prologis?
Oh, I think you're cutting out there, Professor.
Why do I need to do this? Oh,
There
sorry.
you go. You're good. No, you're back.
My
You just
internet
cut
is
out when you said,
unstable.
why do I need to buy Fundrise when I can do Prologis? After that, we didn't hear it.
Thank you. So what you can, sorry, I'm catching my thought. Yeah, so what Fundrise people will say is that their expense ratio, the expense fees that you pay to Prologis is way higher than what you would do if you just buy Fundrise. So their expenses are lower. But on the other hand, there's a pro and a con. So for example, why are the expenses low? Because they don't have to deal with all the regulations. Fundrise doesn't have to. Okay, so which means that Prologis, if I buy shares today and within 2 seconds, if I'm like, fuck, I fucked up, I want to sell it, you can sell it within 2 seconds. Fundrise, if you put your money in Fundrise, then if you want to sell it within a day, then you will have to pay 3% commission, 3% fixed fee. You just cannot take it out. But if you hold it for 3-4 years, then you can get all of your money out. Okay, so Fundrise is, quote unquote, in finance jargon, is not as liquid. Prologis is a very liquid way of putting money.
Also, can REITs charge promote fees?
Promote, as in like if they're a developer, then they get a promote. Is that the promote that you mean?
So some like private funds, if I say like this fund has like a 12% IRR target or whatever,
Yeah.
if we make 18%, that extra 6% gets distributedly more favorably to the Fundrise, the business kind of, and they can make money through overachieving rates of return.
Yeah, so typically the way all of this would work is, so for example, if let's look at this property right here. What they would do is Fundrise will be the holding company and they would form a LLC. And then through that LLC, they would buy this property in Forney, Texas. And when they form that company and when they do stuff with the debt holder there, because somebody else is paying, they can have that promote language in there. That's totally okay.
Wait, so are they making an LLC for every single one of these properties?
Absolutely, yeah.
Really?
Absolutely.
And that's just so that their like legal liability is just within each individual property. Is that the idea?
That's right.
Okay. And then taxes, obviously, I guess would be. Isn't that kind of a tax nightmare though? Because you have to do taxes and legal stuff and all that stuff for each individual property in a separate LLC, or is it not that bad?
Well, it is. I guess it depends on how you look at it, but it's just that's how you do things.
Okay.
Because you don't want, let's say you have this single family commercial renovation in Los Angeles. If for example, I don't know who the manager is. Let's say Jack is the manager of this building, and if Jack sort of messes up somehow, then some tenant can sue. You don't want that lawsuit to be affecting everybody else. So you want that, it's called liability. So you just want that lawsuit to be constrained to that property at the most. So that's why you do everything through an LLC.
Professor Patel, does this also have the tax benefits of depreciating the assets?
No, it does not. No, it does not. So what will happen is every year you will get a 1099 form and you pay taxes on the dividends that you get paid. But it does not have any of the tax advantages, but you don't have any headaches either. Like while watching, I don't know, some YouTube video, you're just putting $50 a month toward this fund and you're done.
And then I believe you get long-term capital gains, right? Which under 40K, assuming you sell, under 40K is 0%, I believe. So that should be still pretty favorable, I guess, obviously in comparison to regular real estate.
Yeah, fair enough. But long-term capital gains in normal stock is also low.
Yeah, no, you're right.
But good question, Jerry. Any other questions before I move on to others?
Yeah, I have a
Second
question
thing.
for you,
Yeah.
Professor. In terms of diversifying your financial portfolio, where does this sit for you in terms of, how much of your investment are you investing with this company?
So yeah,
Not you personally, but just in general, like what would you think? Sorry, I didn't mean to put that on you.
So there are different ways in which you could do this. So very much to what Jerry said, like Jerry was concerned about taxes, and I get concerned about taxes as well. So I have some money that I put in an IRA account, where and then through an IRA or through other sources, if you put money in this fund, then even the dividends that you get paid are not taxable. So this is after tax money that you put in there, and then you sort of reinvest. So I don't think I answered your question, but maybe let's say of all the money that I'm saving, maybe 10% of the money goes here.
And then do you hold more physical real estate, I'm assuming, than in Fundrise, or?
You don't own any physical real estate.
No, I'm saying that
in
you
Fundrise.
personally, do you own more physical real estate than in Fundrise? I'm assuming that.
Yeah, and slowly I'm getting away from it. I don't like physical real estate at all. I'm very different than most of you. I do not want that. It's just a lot of headache for me. Okay, so let me show you a new way in which people are doing things. Any other questions before I move on? Okay. Okay, so I probably will not be able to do justice to this because I think we are running out of time. But let me tell you, this is the new way of doing. So what happens is there's a company that is being made. It's called Realty Co. What does this company do? Apparently in 1 hour and 7 minutes, there's going to be an auction. And what this company does is it buys a property up. It literally buys this property. So apparently it has bought this property. And then what it will do is once it buys it up, so it has bought, it's really, typically these are really shitty properties. Yeah, so it's apparently it's paying $55,000 for this. And then the way you sort of make money is you just get money based on the rent that you get. But the way it works is, and everything is done through blockchain. So the question is, how are they paying $55,000? Once they buy the property, then what they do is they set, and this is the part that I don't exactly understand, is they buy the property through LLC. This LLC in turn issues tokens, Ethereum tokens. Issues tokens, and you can buy each token through Ethereum. You just pay them some Ether and you can get token. So this is literally going back to the old stuff that we were talking about. If Kiana wanted to buy a property, what she can do is typically what she will do is she will issue shares to all the equity holders. And then what she will have to do is she will have to literally in a notebook, metaphorically speaking, write down who the shareholders are and say how many of them bought this. Okay, so with blockchain, everything is easy. What you can do is you can just keep track of everybody who has bought this on the blockchain, and everybody, let's say I want to buy more percentage of this, so I can just buy more tokens. And the key thing here is, in the olden way, when Kiana sort of wanted to buy the property, she kept track of all the shareholders. And let's say if Jack is one of the shareholders, 2 years down the road, if Jack is like, I want to get out of it, he may have to do a retail roadshow to say, hey, this is the property that Kiana holds. She's the majority shareholder, but I want to get out. How much are you willing to pay? He will have to do all of that nonsense. Now, if I want to buy this, I can just go to that person who owns it and say, hey, I want to buy your token, which means that I'm going to be the new shareholder. How much are you willing to pay? How much do you want for this? And all the shareholders will be on the blockchain. So you can literally keep track of what the tokens are being sold for. Question is, Pratish, why would somebody want to do this? Somebody may want to do this is because if you buy one token, this company claims that you will be getting paid $5.65 a year in rent. So you paid Ether to buy this token, but you get paid in Tether, so US dollars for this. So, and everything is on the blockchain here. Okay, so again, this is this is sort of a new way of thinking about it. I do not have money here. So what they're doing here, which is interesting, is they are trying to raise money from non-American investors. It turns out that a lot of international investors want to buy American real estate, but legally they cannot. But cryptocurrency regulations have not caught up yet. And so if they do stuff like this, then they can buy tokens in real estate, but they don't have to be a qualified American investor to buy this. Okay, so they're going after non-Americans to sort of raise money. Okay, so if you go here, again, they will kind of do simple pro forma for you. So they're, for example, issuing for each 1,100 tokens. So if you want to buy the whole property, you can buy all 1,100 tokens. And each token is $50.71. And they kind of give you a sort of how old the property is and so on and so forth. And then they tell you that, you know, I remember looking at this a while ago. A while ago, they would only be buying properties that had Section 8 vouchers. But now they're not. But it's fully rented. Okay, so it's fully rented. And then they're saying that if you buy this, the rent is $9,000. And then monthly cost is $232. So how do you break out the monthly cost? Pay property management. So this includes taking care of all the phone calls and so on and so forth. They do sort of expense a little bit for maintenance. Having said that, I would expect that if property built in 1943 would have more than $40 in maintenance per month, but that's the only thing that they're sort of attributing that to. And they have to pay insurance, obviously. They have to pay property taxes, but they're basically claiming that the net rent that you get is $517. And and you get about 11% yield in your investment. Okay, so this is again a new sort of way in which real estate, I believe, is going to be completely broken down the way people are currently doing things, because this sort of crowdfunding ways are going to take over especially for people you and I, who may not have enough income traditionally, maybe, and we can sort of raise money in this manner. But you have to do a lot of due diligence. If you just go on the websites, there are hundreds of websites trying to crowdsource money. So you have to sort of truly believe in the program, just make sure that they have appropriate stuff. But if you believe in it, then I think that it's good.
Professor, are those tokens first come, first serve? Is that why they have like the whole advertisement for when it's coming to the market?
Yeah, it's first come, first serve. But if you're late, Sasha, guess what? You can go. You can go and, so for this one is not out yet. But here you can just look at all the holders and contact a holder and just buy their token from them if they want to sell it. Literally like that.
Is there liquidity though in this?
Yeah. If you
Okay.
look at, I've looked at other properties and the tokens sell back and forth all the time.
Okay.
Yeah, it looks like they only have the older ones. It looks like they spend some time and then eventually they get them on Uniswap, so you can just, people can put them up for sale or not. Then it looks like they have a marketplace built into the website as well. So unless you have an account, which you have to be an accredited investor for currently in US, then you can browse the marketplace, kind of like if any of you have ever been on OpenSea, where it's just a marketplace of like 10 million different Ethereum NFTs. It should be just like that.
But to summarize, go. Let me summarize, Jack, and then you can ask a question.
Yes.
Summarize, I do believe that it's never too late to invest. So you should be investing in something as a too young. And the only thing I'll say is do consider investment in real estate, but never, ever put 100% of all your money in real estate. I would never recommend that. But I think real estate does add diversification benefit to it. And there are different ways of investing in real estate. Most people think of real estate as physical real estate. I wanted to sort of give you examples of where it's not physical, it's more like paper money, but nonetheless, you're getting exposure to real estate. That's what my sort of point was. With that, I'll stop. And Jack, do you have any questions?
So for this like Ethereum platform, is your investment tied to crypto's price? Like if Ethereum drops, you could like lose all your money, even though the real estate is actually all good?
You have exposure to Ethereum, yes.
Yeah, okay.
Yeah, and what I've noticed in some of the digital real estate that I own, which is getting even way further into the weeds, because that's basically just an NFT, but is it like the price is tied usually on a lot of those platforms that use ETH, it's tied to ETH, but then if ETH drops or rises, sometimes the price lags behind the price change in US dollars, because people have made a bunch of money, or it gets really complicated because if the price rises, then people might lower the price in ETH, but sometimes they take their time doing that. So there's like ways to arbitrage that as well. Because you can kind of be like, okay, it's going to be up another 100% this month. Let me sell into ETH now, and then I'll buy in when it's cheaper later. And so you can like play on that as well. And people do that all the time. And so that's why the markets for a lot of these things are just crazy, because if the price of ETH changes a lot, the price on the marketplace is wild as well, for sure.
That's it for me. If you guys have any questions, I'll stick around. Otherwise, have a fantastic quarter.
Thanks,
Thank
Professor.
you, Satish. Good to see you.
Thank you.
Yeah. Bye.